Okay, the next question is how to understand whether the transfer pricing applies to you and whether you are liable not only to observe transfer pricing, but also whether or not you are liable to prepare the transfer pricing documentation and what kind of transfer pricing documentation it should be. So in this example, in this diagram, I propose I have to explain the logics behind the analysis of the situation for the particular taxpayer. It seems quite complex, but actually it's not so complex. It's very simple. But first of all, you have to ask the right questions and in the right sequence in order to understand whether you are liable to transfer pricing and whether you are liable to prepare transfer pricing documentation. Okay, the first question is whether to ask yourself is whether you are doing a transaction with related parties or not. Related party. You have to look for this reason to Article 1, Paragraph 18 of the Taxes and Duties Act. So there is a definition of related parties. With the one exception, there are no indications about the transactions with offshore or low tax jurisdictions. So this step I kind of excluded in this as an additional step. So first of all, you should look whether you are doing a related party transaction with a related party, and if not, you have to ascertain that the party is not located in the low tax jurisdiction. Yes, the most important in last years is Russia, that previously was not considered as low tax jurisdiction, but as of the 1st July 2023, Russia is considered as offshore, and all the transactions with Russian companies should be at arm's length. And also transfer pricing documentation should be prepared, as we will discuss later. So the first question is whether you are doing with related parties or offshore companies. If the answer is yes, then we should look at the Article 15.2 of the Taxes and Duties Act, whether you are in this category of the taxpayers which should prepare the transfer pricing documentation. And this article you will find basically three categories. First is related parties, but which is very important, not all the related parties, but only related parties which are foreign companies. So if you are making transactions with local Latvian company, so transaction is between two Latvian companies, then no doubt you have to apply transfer pricing principles and observe arm's length. But you are not liable for the to prepare local or global transfer pricing documentations. Usually, in this case, simplified documentation or even set of documents which proves the arm's length would be sufficient. Yes. So in this case, only if you provide transactions with foreign-related parties, then you should start thinking about preparing global or local transfer pricing documentation. The next category is physical persons, individuals who are the owners of the business, more than 50%. This is a separate category, and the third one is offshore companies, the related parties which may not be related, but which are located in the low tax jurisdiction. So, in dealings with those companies, you have to also consider preparation of local and global transfer pricing documentations. So, if you are within this category, so basically, for example, if you are carrying out transaction with a foreign related company, then you have to count the value of control transactions. So, and here's the tricky part, that the value of transactions is calculated like summing up all the amounts, regardless of the revenue or expenses, counting all that together, this plus kind of value. So you cannot deduct anything from that. For example, even in the situation if you have a related party, for example in Lithuania, you are buying raw materials from Lithuania for 1 million, then processing them, making something new, and selling back to this to the same taxpayer in Lithuania for 2 million. So this means that the value of controlled transactions will be 3 million, not 2, not 1, but 3. It's 2 plus 1. So you have to put everything together. Moreover, it's very important, and sometimes it's omitted in practice, that in case of the loan transaction, the loan principal is also should be considered as the value of controlled transaction, but only once, when you either receive or make a loan or receive a loan. Upon the issuance of the loan. So, for example, if you have a loan, if you have borrowed 10 million in the year 2024, for example, in July, and then repaid this loan in September, so it takes a few months, but still it will be considered that the controlled transaction value is 10 million for the year 2024. So for the loan, you should count this loan principal and also plus interest, either received or paid. Yes, so accrued interest. So regarding, so this is clear regarding the values of controlled transactions. Then you should count everything together and check whether which documentation corresponds to the value of your controlled transactions. And there are 3 thresholds. First threshold is 15 million. Let's make it in this picture, which is more kind of bigger scale. So first threshold is 15 million. Yes, if you have transactions over 15 million, controlled transactions, then you should prepare local documentation and you should prepare a global documentation. And you should submit within 12 months this documentation to the tax authority. So without any questions, within 12 months, you should submit transfer pricing documentation for the year 2024. You should submit it by the 31st of December 2025. Yes. Yes. So, and even if the situation, as we discussed, even if you have this short loan, for example, loan principal is 20 million, and loan is issued to several months. Even in this situation, you are liable to prepare both documentations. Probably in this case is not very kind of fair, but still this is a requirement of tax authority, and if you are not doing this requirement, kind of not fulfilling this requirement, tax authority may apply penalty for 1% of this amount of a controlled transaction value, but capped at 100,000 euros per year. Sorry. So basically, if you, in this case, if you ignore this requirement, then tax authority may automatically apply this amount of penalty. So next threshold is 5 million. So if you have controlled transactions between 5 to 15 million, then you should prepare both documentations. Also, you should prepare both of them. But local documentation, it's mandatory to submit it within 12 months period. But for the global documentation, there is a question mark, because in this case, you should test also the turnover of the company. If it is over 50 million, so turnover revenues of the company, the total revenues, not only the revenues with related party, but all revenues. So if it exceeds 15 million, then you should submit the global documentation also within 12 months period, the same as in first threshold. But if it's less, then you should submit the documentation upon tax authority's request. So in practice, this means that tax authority may ask, for example, if tax authority may come to you and ask in the year 2026, they may ask to submit global documentation for the year 2024. And in this case, in this year 2036, they will give you 1 month period in order to submit this global documentation. Okay, so yes, what you should remember, if you exceed 5 million, then local file is mandatory. Global file probably may wait for some time, but still it's also valid and tax authority may ask for it. The next level is 250,000 euros, and exceeding this amount, you should prepare local documentation and submit it upon tax authority's request. So basically, you have to prepare it, but you are not required to submit it mandatory only if tax authority asks for it. Okay, so what happens if you qualify for this under this section? You have related party transaction, but the value is less than 250,000 euros. And this what happens then? Then you have to prepare so-called simplified documentation, and by simplified documentation I mean that corresponding to requirements of governmental regulation 677, which means that you have to prepare functional analysis, method selection, and comparability study. So basically, these three things, and yes, so that's basically it. So sometimes there is one question, one thing which is important to know, that if you have separate transactions for less than 20,000 euros, then those transactions may not be not required to be analyzed in the transfer pricing documentation. So those could be omitted. And of course, in practice, probably it's sometimes you have to evaluate those transactions whether they are risky or not. For example, if you buy the fixed asset for 15,000 euros and it's visible that this fixed asset is the value, the price of it could be easily estimated, and there are no reason to analyze it in more detail. But instead, if, for example, 20,000 it's management fee, then of course tax authority may ask to may see some risk. For example, if we talk about management fees, particularly management fees involve not only risk of being not arm's length, but sometimes management fees could be not allowed to be deducted at all, because tax authorities simply do not believe that you have received some services, and therefore the payments may be reclassified as non-business payments. So that's why even if the transaction values are lower than this threshold, still you have to analyze and understand whether there are or are not risks associated with this transaction. Okay, so when we get the big picture, let's go into detail. First of all, let's discuss what are related parties. So, as you remember, related parties are those which are listed in Article 1 of the Taxes and Duties Act, and basically this is a first question which should be answered, whether or not you are making transactions with related parties. So what are related parties? Here is a list of related parties, but let's go already in discussion. But first of all, related parties are parent and its subsidiaries. And subsidiaries could be direct subsidiary, direct participation, when A owns more than 50% majority of the voting rights in company B. So this is direct participation, and participation could be indirect when the company A owns majority in company B and company B owns majority in company C. So basically those companies are A and B are related. And when we discuss the majority, it's important that here is the majority is here and here, but we are not calculating like 50% times 50% and then some percentage. Yes, it doesn't work like this. It is sufficient that A controls B, B controls C. This means that A controls C. The same is situation if there is indirect participation, if the A controls two companies B and C together controls the company D. So in this case it's 20%. It should be more. For example, in this case it doesn't control. It controls 40%, but if we assume that here are 26% and here are 26%, for example, then it totally would be 52%, and then it could be that a company controls. We could conclude that a company controls company D. So in all these cases, those companies are considered as related companies. Next, direct participation, and this is important because the rule of direct participation, 20%, 20 to 50%, these companies are also related, but only if they are foreign related companies. They are not. If there are two Latvian companies, then those companies are not related if they own for less than 50 or less percent. So if there is this 50% participation, it's not majority anymore. But if these companies are foreign companies related, then here are these are also considered as related companies. Yes. In case, for example, if UAB would own 51% control, and here SIA would own another company like, I don't know, 49%, then here is this direct ownership. These companies, for example, UAB, then these companies are related, but this, okay, let's say here's not UAB, but OU, for example, Estonia. So UAB and SIA would be related. SIA and OU would be also related based on direct participation, but UAB and OU wouldn't be related companies anymore. So direct participation only for foreign companies. Okay, here the control could be also based on relatives, on family ties. For example, company A and company B are related if there are spouses, John and Eliza. So in this case, each of them has majority in its own company, but since they are spouses and they are kind of in relationship, marriage, then those companies A and B are also considered related. So in this case, if, for example, one has C in Latvia and has UAB in Lithuania, then of course all those transactions are not only subject to transfer pricing, but also for assuming that here are, for example, 5 million control transactions, then of course the transfer pricing documentation should also be prepared. Also relatives to certain extent also could be could have a controlling power. So for example, the two companies are owned by the relatives, like by parents or other sister, brother, and other relatives, then also those companies could be related. And sometimes even if the persons are not relatives, not in marriage, or not has nothing kind of no ties, Yes, but still the law says that the two companies could be also related. A and B could be related if these companies are, majority of them are owned by the same up to 10 persons. So basically, if there are 5 persons unrelated between themselves, not relatives, not in marriage, and not spouses, and so on, and if each of them, for example, owns 12% in company A and 12% in company B, it makes together 60%. It's majority here and majority here. And so those companies are also related companies. Okay. The next criteria for related party is board majority. So basically, what the law says that that the companies are related if the majority of board in those two companies are the same majority. Yes. So in this case, we have 3 board members in company A and 2 board members, Peter and Eliza, in company B. So here are 3 and here are 2. So majority 2 out of 3, you would agree, is majority. That's why those companies are related. Yes, there are several, or at least one incorrect view in this respect to the board members, and which is kind of quite widespread. And then that, for example, if the board member has the representation rights to represent the company by himself. So without consent of the others, but it doesn't mean that this board member is in control of the company. Yes, so if he has a signature rights to sign everything alone, but still it's not sufficient to. It's not a majority. It's not a majority. You should be in majority because for this reason, for example, one board member can sign something and the next 2 board members can sign something different tomorrow. Yes, so that's why the relation seeks for a majority, not for the representation rights. So this is not correct. If someone says that you have a separate rights to represent the company, then it doesn't mean that you have a majority of the board. So the next, also the one misconcept is that the board member in relation to the company is also not considered as a related party. It's also a misconcept. Of course, such concept is in the commercial law, but this is something different. So if we are speaking about taxes, about transfer pricing, then this is also not true, but because the board member is just a kind of authorized person, and if board member makes some transactions with this company, this should be evaluated, of course, from commercial perspective, from commercial law perspective, but not from tax perspective. Okay, so the last is about the physical person or individual. If one person owns a company and or it has a majority one or few companies, either by himself or herself, or by means of her relatives up to 3rd degree, or persons related to affinity up to the 2nd degree. Yes, and directly or indirectly owns more than 50% of the company share capital, then he is considered as the related party. And for example, if I have a company, if I fully own a company and make transaction with my company, and I try to give shares to my wife, to my some relatives and so on, so it still be considered that I am the owner of this company, and if I make the transaction of this with this company, this transaction should be at arm's length. Okay. Yes, and the last thing which is mentioned also this Article 15 of the Taxes and Duties Act is that the transactions which are carried out with low tax jurisdiction, and yes, and it is interesting to note that all the jurisdictions are listed in the Cabinet of Ministers. But this list is not very kind of long because most of those jurisdictions have signed the convention about the exchange of information, and that's why are not considered as low tax jurisdictions anymore. So that's why, in order if you are in doubt which country is or not the offshore, you have to visit this link. OECD organization link, exchange of free information, status of convention. So this is status of implementation of this convention, and if the country has implemented this convention, it means that the company has not considered to be an offshore anymore. And as I mentioned, there are some islands which are still present in this list, and for example, if I'm not wrong, Panama, and also from 2023, it's Russia. Okay. Yes, and this is related about related parties, and this is kind of I'm starting to kind of to repeat is that this is this Article 50.2, which basically says that the documentation should be prepared by if there are transactions with related parties, if the physical persons are doing business, this company, the owner, and if there is a transaction with low tax jurisdiction. And in this table is also the same summary of we have already discussed. Probably this table is easier to understand, and this means that here are requirements for global transfer pricing documentation and for local. And so we have discussed this already in detail, which documentation should be prepared and which should be submitted mandatory and which should be submitted by tax authorities request here. Yes, but if we do not qualify to this section, this means that we should check the governmental regulations number 677 and prepare documentation like simplified documentation based on these regulations, as we discussed. The simplified documentation includes functional analysis, method selection, and comparability study or benchmarking study. And if there are the transactions less than 20,000, then these are considered immaterial, but still be careful that depending on what the transaction is, sometimes if the transaction is you cannot substantiate it and it's like payment for nothing, then tax authority may easily say that please prove it, or otherwise we will not count it as or we will count it as the non-business expense. Okay, and the last situation which may arise, but it's quite very kind of not it's quite exceptional situation, is that law says also that sometimes tax authority may ask to prepare documentation also for the transactions with related local companies. Yes, provided that the value chain of the transaction goes beyond Latvia. So here are like some foreign country, and here are foreign country, Lithuania. Yes. So in this case, tax authority may ask you to provide the documentation also for this. So this transaction, even it is not required by the law. It's not a transaction with a related party, but if the value chain goes beyond Latvia, then sometimes tax authority may consider that they need to analyze also this transaction as well. So this is basically it about the transfer pricing scope of the transfer pricing, what the transfer pricing is, who is liable for transfer pricing, and who is required to prepare transfer pricing documentation, and what are the requirements for doing that. So I hope you enjoyed this video, and if you have questions, please do not hesitate to contact me. We have a quite extensive transfer pricing practice, and we will be pleased to help you as well. So goodbye.